Have we finally hit the bottom? Has the market finally recognized this business is not actually going bankrupt? There was no massive jump after earnings after yet another solid quarter, but the fact the share price did not drop yet another 5% plus feels like a win. It feels like the narrative surrounding this business in 2025 is being questioned. The narrative is not dead, to be sure, but some are now looking at Adobe and saying, hey, this business keeps doing numbers. Welcome to The Quality Investor. On today's video, I want to break down Adobe's earnings release and do a wellness check on the narrative that AI has destroyed SaaS operators. No doubt Adobe has been a dog in 2025. The digital editing giant has been crushed in 2025 and really the last 5 years. Year to date, Adobe is down 21.2%. The last 52 weeks, down 39%. The last 5 years, however, Adobe is down 26.4%. That is 6% on an annualized basis. These are not the returns investors expect from a highly profitable software company, and one whose business model is almost entirely made up of subscription revenue. Now, in that 5-year period, Adobe has grown revenue 14% annually, grown earnings 15.6% annually, and grown free cash flow by 14.4% annually. This is clearly a case of mismatched market sentiment and reality. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. So, did Adobe do enough this quarter to reverse the negative sentiment hanging like a dark cloud over this business? First, some context around this negative sentiment. The negative sentiment is driven by two main factors. The first is AI monetization, or lack thereof. Seemingly each quarter, the market is expecting Adobe to issue highly optimistic guidance that reflects faster revenue growth driven by monetizing AI, specifically Adobe Firefly. This has not been the case, and the market usually drops Adobe 5% post-earnings, and the stock continues to decline throughout the quarter. The second is a general feeling by Wall Street experts that Adobe's business model will be completely wiped out by AI, specifically AI performing the tasks that usually require highly skilled graphic designers. This, in my view, has really been the culprit behind share price decline and has affected other software giants such as Salesforce. I discussed why I do not buy into this narrative and what I believe what will happen, at least in Adobe's case, in prior videos. I have linked those below. Well, yet again, Adobe had a strong quarter, throwing more shade on the AI disruption narrative. This time, though, it seems like the market is at least curious about this. On this channel, we worry about the actual data, not the hype. Adobe delivered 11% year-over-year revenue growth. In fact, revenue growth has accelerated each quarter in fiscal year 2025, albeit slightly. I'll dig into the rest of the financial statement and margins shortly, but as far as segment reporting, the all-important digital media segment, which houses the AI offerings, also grew at 12%, also accelerating each quarter. The annualized recurring revenue, or ARR, however, grew at 11.7%, now sitting at $18.6 billion. Adobe has raised its guidance for the year for revenue to $23.675 billion at the midpoint, up from $23.55 billion. They raised their adjusted earnings per share guidance to $20.82 at the midpoint, up from $20.60, a pretty large raise. Interestingly, this is the second quarter in a row Adobe has raised guidance. The stock is up pre-market just over 2%. Not much at all, and we'll see how it performs over the course of the day. But this signals to me that the market is at least acknowledging Adobe might not be dying after all. The major theme on the earnings call was AI integration across Adobe's platforms. The company said AI-influenced ARR has surpassed $5 billion, up from $3.5 billion at fiscal year end 2024, and has already exceeded its full-year AI target. This AI integration has helped drive user growth, with combined monthly active users for Acrobat and Express up 25% year over year. User engagement with AI within Acrobat is up 50% quarter over quarter. Adobe's strategy with AI monetization is to use a freemium model to attract users and drive engagement. Once locked in, Adobe can upsell them to premium plans. That strategy is starting to bear fruit. Their student cohort, an admittedly small cohort, has seen 80% year-over-year increase in premium plans for Express. Additionally, Adobe's flagship AI app, Firefly, has grown monthly active users by 30% quarter over quarter. And more importantly, first-time subscribers through the app grew 20% quarter over quarter. Adobe's AI strategy focuses on driving user engagement first and monetizing that engagement second. The reason for this is Adobe wants users to need their product. Once they need it, they will pay for it. As I mentioned earlier, I explored this strategy in detail on previous videos. I believe this quarter is showing the first tangible results of the strategy. This is a long-term strategy, so if Adobe keeps executing this high AI growth, we will start to see revenue growth accelerate at a higher rate. And this is why I've remained bullish on Adobe despite the market malaise over the last year. So let's dive into Adobe's financials and review what kind of growth I am projecting. Then I'll assess what I believe is their true intrinsic value and tell you why I believe Adobe is worth considering for your portfolio. Adobe closed right before their earnings at $350.55, but now it looks like they're up 3.25% pre-market, so we'll see. It's been steadily creeping up in the pre-market trading this morning. Maybe this bodes well for what we'll see today. Adobe definitely needs a little bit of a catalyst to jumpstart it from its malaise. You can see all that red year to date down over 20%. So hopefully the market starts to recognize that sentiment and reality have been mismatched and Adobe will start to recover. A couple key highlights here. Adobe achieved record revenue of nearly $6 billion in its third quarter. And like I said, that is about 11% year over year growth. Operating income was at $2.17 billion. Cash flow from operations was at a very healthy $2.2 billion. And exiting this quarter, remaining performance obligations were at $20.44 billion. Now, this is what the big catalyst was for Oracle the other day. Now, keep that $20.44 billion in mind. You'll see in the guidance that that's not quite what their revenue is projected for the year. The fact that Oracle had a massive RPO when they exited their quarter, that's one reason why Oracle has shot up in share price, but Adobe didn't quite get that same lift. And the last thing here is Adobe repurchased approximately 8 million shares during this quarter. I will touch on that more in a second. So here's that $5.99 billion in revenue for the quarter, the 11% increase year over year. So far year to date, we're at $17.6 billion, which is about a 10.5% increase year over year. Operating income coming in at $2.2 billion for the quarter. The operating margin here was actually 36.29% for Q3, which was a slight margin contraction year over year, about 54 bips worth. However, the $6.4 billion operating income year to date gives us about a 36.7% operating margin. Compared that to last year's year-to-date operating margin of about 30%, although there was a one-time event that skewed that number a little bit. It is good to see margins expand. And all the way down here at the bottom, we see that $4.18 earnings per share, which is a nice 11.2% increase year over year. So Adobe fundamentally is going in the right direction. And because of that, we're getting this nice guidance raise, which is contributing to the small pop we're seeing pre-market. So now they're forecasting between $23.65 billion and $23.70 billion for the entire fiscal year. But what's more important about that guidance raise is that it's actually beating the analyst estimates. You can see the adjusted earnings per share. Now this is for the Q4, right? $5.35 to $5.40, which beats the Wall Street estimates of $5.34. And revenue is the same thing. The midpoint here for revenue in Q4 is a bit higher than the $6.08 billion Wall Street was estimating. And on a full year basis, the $20.80 to $20.85 here, much higher than the $20.57 estimate. And same with revenue, $23.65 billion up to the $23.70 billion, which also exceeds the Wall Street estimate of $23.57 billion. Recently, Adobe has been coming in slightly under these estimates, and the market has been punishing Adobe for that because the market's claiming they're not seeing AI monetization. Well, we're starting to see that now. And one last thing on the financial statements, we have that $2.2 billion in operating cash. Now, everyone knows Adobe is a very asset-light business, so they barely have any CapEx, only $72 million in CapEx for this quarter. That is translated into free cash flow for the quarter of $2.1 billion. They're on track. They're on track for nearly $9 billion of free cash flow, at least by my estimation. If they do hit $9 billion in free cash flow for the full year, fiscal year 2025, that would be over 14% year-over-year growth and clear acceleration in free cash flow growth over the last 3 years. But what I really wanted to show you on this cash flow statement was this down here, repurchases of common stock. They said in their highlights that they repurchased 8 million shares. You can see in this quarter, that means $2.05 billion in share repurchases, nearly all of their operating cash flow. Normally, I don't talk about share repurchases all that much. I certainly like to see it as an investor because it increases my admittedly very small ownership stake in the business, and I don't believe they necessarily add organic value. But in this case, they're actually a good thing because of how beaten down the share price is, and that's why I wanted to point it out today. In my opinion, this very much falls into the Warren Buffett category of share repurchases, where it's good when a business does it when that share price is far below its intrinsic value, and you'll see what I believe that intrinsic value is here in a second. So Adobe is clearly taking advantage of this decrease in share price. And remember, when a business is repurchasing their common stock, that means they don't have a better use for that cash elsewhere. Whatever acquisitions Adobe's currently valuing at the moment are not as value add as repurchasing the stock. Clearly, repurchasing the stock at this point is better than paying off any debt. So Adobe, I think, is making the correct capital allocation here. I want to show a couple tweets here that have been discussing Adobe post earnings. Again, I think that narrative about AI disrupting the entire SaaS industry is slowly getting debunked. To me, it's similar to that narrative we saw for Google in 2024 and early 2025 about how OpenAI was going to completely destroy search. Yet Google just keeps blowing their earnings out of the water. We're seeing that same thing with Adobe. And this tweet just points out, is this what being disrupted by AI looks like? And you see just incredible revenue growth on a quarterly basis here for the last 12 months, quarter over quarter. I mean, this is the kind of thing you want to see as an investor. Another tweet here by Marvin Labs. Wall Street underestimated Adobe in 3Q 2025 as subscription momentum in AI demand drove better than expected results. And here's some important aspects. They go through some of the results here, but this right here, the sizable adjusted earnings per share growth outpaces revenue improvement, signaling operational leverage. Robust digital media gains highlight sustained end market demand and successful AI monetization. This is what the market has been looking for. They want Adobe to monetize their AI. Well, Adobe's starting to do just that. To me, it's kind of ironic. The market is mad Adobe is not monetizing their AI, especially their AI app, Firefly. Well, they have been mad at them for that. But at the same time, they also believe Adobe's going to get completely disrupted by AI. The market needs to pick a lane and stick with it. Either way, I think we're starting to see the first signs of recovery for Adobe, and hopefully they can continue this momentum going forward. And while we're not going to see massive gains in the share price today, or maybe even over the next couple weeks, I think we're going to see that steady rise now for Adobe over the next few quarters. But they still need to execute. That is the important part here, and I do believe they will do so. This is a revenue segment breakdown for Adobe year to date. A couple things I want to point out. That digital media subscription segment here, look at that growth quarter over quarter, 11.65, 11.8, now at 12.1%. That is acceleration each quarter in 2025. It's a tiny bit of acceleration, but it's acceleration nonetheless. And as they continue to monetize AI more, we should see that rate continue to increase. Subscription revenue overall, we've seen 11.6% increase year to date, 11.8% increase for this quarter, acceleration from Q2 of 11.5%, and revenue overall grew at 10.7% for this quarter, and we're at 10.5% on a year-to-date basis. These two segments here are becoming irrelevant for Adobe: product revenue and services and other revenue. Clearly, they're phasing them out and going strictly to a full subscription revenue model. They currently have 96.2% of their revenue coming from subscriptions. What am I projecting now for the next 10 years in Adobe? Well, the digital media over the last 5 years has seen 16.6% growth annually. My projections on a bear case are 8% up to 10% on the bull case. Quite conservative compared to what they've done historically, but we'd like to be conservative on the quality investor. For the digital experience, again, conservative compared to the 5-year CAGR. 12.7% historically, 6.9% on the bear case, up to 9% on the bull case. That translates into total revenue growth over the next 10 years, 7.3% for the bear, up to 9.44% on the bull case. In year one, I'm projecting now 10.33% growth. That is based on Adobe's latest guidance. Operating margins, I expect them to continue to grow. 36.25% here on a trailing 12 basis. On a bear case, I have them growing to 37% by year 10, up to 39% for the bull case. And to me, this is going to be very conservative. If they continue to monetize AI and demonstrate better operating leverage, as that tweet pointed out, we should see much higher operating margins by year 10 into the 40% range. Free cash flow margin on the bear case, I have that at 34.9%, up to 41.3% for the bull case. Essentially, I'm projecting flat free cash flow margin growth over the next 10 years. Keep that in mind as you see these buy prices. Adobe has a free cash flow conversion rate of $1.38 on a 12-month basis. In other words, for every dollar of net income, how much becomes free cash flow? And I'm projecting $1.20 by year 10 on the bear case to $1.30 for the bull case. And as businesses mature, typically the free cash flow conversion goes down. So that's why it is going down from the trailing 12 number here. So going into market trading today, Adobe's share price is at $350.55. That is a 21.8 PE. We have a 21.2 forward PE, but both of these PE ratios are far below their 5 and 10-year average. This is some of the cheapest Adobe has ever been. And given that share price at $350, the market itself is projecting over the next 10 years negative free cash flow growth. Negative 0.4% annually over the next 10 years. That's abysmal sentiment right now in the market for Adobe. I'm projecting 6.64% on a base case here. So even I'm being incredibly conservative in my free cash flow projections. In the bear case, I have 4.7% free cash flow growth. And on the bull case, that's at 8.6%. So again, nothing crazy here in terms of free cash flow growth. And when we look at these DCF prices, $516.66 on the bear, $604.21 on the base, $707.27 on the bull. Massive upside across the board for Adobe. And the exit multiple is at $577.80. And the average exit multiple for Adobe is at about a 36 PE. The comps I'm using for Adobe are Oracle, Synopsys, and CRM or Salesforce. So nothing completely out of the ordinary here on a comp basis either. I believe Adobe is just massively undervalued at this point. Without any margin of safety, we have a buy price of $597.49. With a 20% margin of safety, that's a buy price of $477.99, a forward P of 28.8. We're currently, maybe not after today, but currently nearly in the 40% margin of safety range. The market has just really been down on Adobe. The AI narrative of total SaaS disruption has beaten this stock down. And I think Adobe's finally starting to show that that's not actually happening. And in fact, as they continue to monetize their Firefly and their other AI integration, Adobe is going to start to accelerate their growth, and the market will respond accordingly. As you just seen, I am not being wild or outlandish in my projections at all. I'm being very conservative. I'm not really accounting for what that AI growth could potentially be because I simply don't know. And that's why I'm being so conservative. So even if Adobe just maintains at their current pace, the free cash flow they're going to generate for investors alone justifies, in my opinion, a much higher share price. The disruption's not going to happen, and we're seeing that in the results so far. So I do think Adobe should be highly considered by investors at this point, and I think we're going to start to see recovery, maybe slow recovery, but recovery for Adobe over the next few quarters. Thank you for watching today's video, and if you've made it this far, go ahead and subscribe to the channel. Thank you, and happy investing.